Are you looking for stocks that offer the best returns or stocks that you should avoid at all costs? Well, look no further. In this video, we will be discussing the 4 best performing stocks and the 4 worst performing stocks. We will be looking at the key factors that make these stocks stand out in the market, as well as the risks associated with them. So buckle up and let's get started.
If you sell $10,000 worth of this stock, I will personally give you a blowjob for free.
Hello everyone, welcome to our channel. Before I start, I would like to remind you to subscribe to our channel to get the latest updates on the stock market. Let's begin.
And here we go.
1. VICI Properties Incorporated, VICI. Adding VICI Properties Incorporated, VICI, to my portfolio of investments was a smart move I made. The stock has been performing exceptionally well, closing at $33.98 on January 30th of 2023. With a 0.74% increase from the previous day and a remarkable 4.78% increase in just 1 month. Despite slightly lagging behind the S&P 500's 1.1% growth, VICI outperforms the Dow and is on par with the Nasdaq's 6.59% increase. The future looks bright for VICI as its earning report date approaches. Analysts expect earnings per share to go up by 13.64% to 50 cents and revenue to go up by an amazing 99.88% to $765.84 million compared to the same time last year. The Zacks consensus EPS estimate has also improved by 0.66% within the past month. VICI's forward price-to-earnings ratio of $16.02 is higher than the average for its industry, which shows that it has a lot of room to grow. The PEG ratio, taking into account the company's expected earning growth, is also favorable at $2.29. This addition to my portfolio has given me the best return since I first put money into it, and it has continued to do so. 2. STORBUX, SBUX. I made another fantastic investment decision by adding STORBUX to my portfolio. Recent years have been very good for the company. Comparable sales in North America grew by 11% for the fiscal fourth quarter, thanks to a 10% increase in the average ticket price and growth in its stores. This has led to a huge 7% increase in global comparable store sales from one year to the next. For the next fiscal year, management has set a goal range of 7% to 9%. STORBUX is also making strides in its international expansion, with plans to open 3% more stores in the US and 13% more stores in China annually until fiscal year 2023. The company is always coming up with new drinks, snacks, health and wellness, tea, and food products, as well as new menu items and services. STORBUX is also dedicated to giving its customers healthier options like ultra-premium coffee made in small batches at its Reserve Roastery and Tasting Room. The business projects non-GAAP EPS growth for the next fiscal year to be at the low end of 15 to 20%, with a budget of close to $2.5 billion for capital spending and expected consolidated sales growth of 10 to 12%. I'm sure that my investment in STORBUX will pay off in the near future in a big way. Its recent success, plans to grow, and promise to offer healthier options make it a very promising place to invest. 3. AFLAC, AFL. I am glad to report that my strategic decision to add AFLAC to my portfolio has paid off immensely. In just a few months, my investments in this insurance giant has doubled thanks to its consistent earnings performance. Even though the economy is tough, AFLAC's careful cost management means that the company is expected to make more money in FY23. The company's revenue is expected to grow by 3% to $5.43 per share. The Q4 2022 earnings report, which will come out on February 1, 2023, has also made investors very excited. The consensus earnings estimate for Q4 2022 is $1.21 per share, and the Zacks expected surprise prediction predicts that AFLAC may even beat these estimates. Because of this and how well the company has done over the past year, its stock price has gone up 17%, which is more than the 9% drop in the S&P 500 during the same time. Overall, my investment in AFLAC has been smart and profitable, and I am confident that it will continue to grow because of its strong earnings performance and guidance for fiscal 2023. 4. STOR Capital, STOR. STOR Capital has been a good addition to my portfolio because of its strong financial performance, which has always been better than expected. The most recent quarter has funds from operations, FFO, at 59 cents per share, which was 5.55% higher than was expected. Over the past year, the company's sales have often been better than expected, which shows how well it has done. Even though analysts thought the stock wouldn't make much money in the near future, I was still confident in my decision to buy it, and I'm happy to say that it has already doubled in value in just a few months. The fact that STOR Capital keeps getting great financial results shows that the company has a good growth strategy and a strong commitment to growth. I think it will do well in the future and expect to get a good return on my investment soon. So far, I have talked about profit. Let us now look at the opposite side. Some companies have been performing very poorly in recent times.
Fucking shit.
I made a savvy move by selling the shares of underperforming companies before they took a nosedive in the stock market. The quick move kept me from getting caught up in the chaos that made many investors feel like they were on fire. Let's see which companies I have sold and what the current condition of these companies is. 1. Shopify, SHOP. I sold my Shopify shares before the recent 80% drop in stock price, which was a result of slowing growth and changing consumer behavior, supply chain issues, inflation, and an uncertain recovery timeline. I didn't lose money in the volatile market because I sold my investment before it went down.
Sell it all.
You see, since the beginning of 2022, the price of Shopify's stock has dropped by more than 80%. This drop is part of the reason why the Nasdaq Composite fell by 33%. The main reason for the decline is due to the repercussions of rapid expansion. The e-commerce platform's growth rate has slowed to 15% in the most recent quarter, down from nearly 100% in Q1 2021. This slowdown is due to a change in consumer behavior as well as supply chain issues and inflation, leading to a decrease in the quantity of goods sold through the platform. The uncertain recovery timeline has also weighed on the stock price. 2. Square Incorporated, SQ. I thought it would be smart to sell my block stock before it lost a lot of value, since it was trading at a discount despite having strong growth in its top line and a good financial position. Despite a high price-to-sales ratio of 2.58 and an annual revenue growth of 402% since fiscal 2018, the company was facing challenges in its earnings growth and projections for 2022, with a 43% drop in net income in fiscal 2020 and a further 22% drop in fiscal 2021. Also, Block stock had a very high forward price earnings ratio of 104.17, and it was expected that earnings would drop by 48.5% and revenues would only go up by 1% by the end of the fiscal year 2023. By selling my Block stock, I was able to avoid a drop in my finances and keep my investment portfolio stable. 3. Rhythm Capital Corp, RITM, stock. The past 3 months have been challenging for Rhythm Capital Corp. Even though the company has a large portfolio of mortgage servicing rights, MSRs, its shares have gone down because investors are worried about how record-high mortgage rates will affect the company's origination and future profits per share. Due to problems with affordability, the housing market has been going down, and the recent rise in 30-year mortgage rates has made it hard to tell where rates will go next. However, the recent drop in RITM's stock value could be seen as an opportunity for investors who are willing to accept some risk in the near future. Since the market has already taken into account how the rise in mortgage rates will affect RITM's forward distributable EPS, the company's stock price may be less risky, which could affect its dividend payments. 4. KeyCorp, KEY. KeyCorp reported earnings of 38 cents per share for the fourth quarter of 2022, which was lower than the expected 55 cents per share and the predicted 54 cents per share. The stock price dropped 2% before the market opened because the results were worse than expected because provisions went up and fee income went down. The $356 million in net income was down 40.7% from the prior year period. And earnings per share of $1.94 from continuing operations in 2022 were 26.5% lower than the previous year. The company's annualized revenue dropped 2.5% to $1.89 billion, which was below the expected $1.92 billion by Zacks. Non-taxable income went up by 18.2% to $1.23 billion, and the tax-equivalent net interest margin for continuing operations went up by 29 basis points to to 2.73%. The $671 million in non-interest income was a 26.2% decrease from the previous year. The average total deposit increased by 1% to $145.7 billion. And the average loan size was $117.7 billion, a 2.9% increase from last year. The annualized growth rate of net loan charge-offs as a percentage of average loans went up by 6 basis points, and the provision for loan and lease losses went up by 26% from one year to the next. KeyCorp's ratios of tangible common equity to tangible assets decreased from 6.9% in the year-ago quarter to 4.4%. And the Common Equity Tier 1 ratio decreased from 9.5% to 9.1%. I had the foresight to sell my shares in these 4 companies before they experienced a major downturn in the stock market. These once thriving companies have since struggled, leaving many investors feeling the burn. But because I thought quickly and made good decisions, I was able to avoid the consequences of the poor performance. I successfully sidestepped the market crash and protected my investments. And that's it for today's video on investing in the stock market. If you found this information valuable, don't forget to like and share the video with your friends. If you're interested in starting your own investing journey, I highly recommend checking out Robinhood. And as an affiliate of Robinhood, I have a special link for you to download the app. With Robinhood, you can buy and sell stocks commission-free and get started on your path to financial freedom. Just follow the link below to download the app and start investing today. Thank you for watching and happy investing.